Imagine cruising down a wide-open highway, surrounded by a silent symphony. Every car glides past, emitting nothing but a faint electric hum. There are no tailpipe fumes, no rumbling engines, just the quiet thrill of innovation. This isn't just a fantasy ripped from the pages of science fiction. For decades, visionaries have whispered about this future. Today, it feels tantalizingly close, but behind the glossy ads and inspiring headlines about eco-friendly mobility, a hidden battle rages, a battle that could decide not only what sits in your driveway, but the fate of entire industries, economies, and even the planet. Let's pull back the curtain. Many of the world's most powerful automakers, those titans whose logos have adorned hoods for generations, are at a crossroads. On billboards and in press releases, they champion electrification, paint themselves as green pioneers, and pledge allegiance to a cleaner tomorrow. Yet, in the boardrooms and corridors of power, a very different story unfolds. Some of these same automotive giants are quietly, and sometimes aggressively, working behind the scenes to slow down the very revolution they publicly claim to lead. Why? The answer isn't just about business. It's about survival, tradition, and the tectonic shifts that threaten the foundations of an industry that has dominated the 20th and early 21st centuries. To truly understand what's at stake, let's rewind and examine how far electric vehicles, or EVs, have come, and why their journey has been anything but smooth. The numbers speak volumes. In the first quarter of 2025, global electric vehicle sales shattered expectations, soaring past the 4 million mark. That's a breathtaking 35% leap from the previous year, according to the International Energy Agency. To frame this in context, just a decade ago, electric vehicles were widely considered niche products, dismissed by many as impractical toys for the wealthy or environmentally obsessed. Fast forward to today, and the Tesla Model Y alone has put more than 3,400,000 vehicles on the world's roads as of late 2024, making it the single most popular electric vehicle globally. This isn't just a statistical blip, it's a tidal wave. Experts at the International Energy Agency describe this as continued market momentum, and some analysts are now forecasting that by the mid-2030s, nearly every new car sold worldwide could be electric. If that vision is realized, the reign of the internal combustion engine, the very heart of 20th century industry and culture, could end within a single generation. Yet, in the United States, the path forward is far more complicated. J.D. Power, a leading market research firm, predicts that the retail share for electric vehicles will hover just above 9% in 2025. Cox Automotive, another major industry watcher, forecasts that electric vehicles and plug-in hybrids combined might barely reach 10% of the total market. Meanwhile, the International Energy Agency estimates that electric vehicles will make up 19% of all auto sales by the end of 2024. On the surface, this looks like momentum, but compared to parts of Europe and China, where electrification is advancing with breakneck speed, the US market is crawling forward rather than sprinting. So what's holding back the revolution in a country that once prided itself on being at the cutting edge of automotive innovation? The answers are layered and complex. Let's start with the most obvious obstacle: price. According to extensive research from McKinsey and PwC, the vast majority of North American buyers draw a hard line at $45,000 for an electric vehicle. In fact, about 60% of consumers interested in electric vehicles simply won't consider anything pricier. This affordability gap isn't just a minor inconvenience, it's an existential barrier. For millions of families, the promise of zero-emission driving remains out of reach, especially as inflation and economic uncertainty bite into household budgets. But the price tag is only part of the story. There's also the matter of infrastructure. While major cities like New York, Los Angeles, and San Francisco now boast growing networks of fast chargers, vast swaths of the country remain charging deserts. Rural drivers, road trippers, and those living in apartment complexes often find themselves shut out of the electric party. Imagine being unable to charge your car at home, or facing the prospect of waiting hours at a remote highway rest stop. Until these pain points are addressed, the electric dream risks becoming a nightmare for many. Yet perhaps the greatest and most surprising obstacle comes not from politics or technology, but from the industry itself. R.J. Scaringe, the dynamic CEO of Rivian, a company that has rapidly emerged as one of America's leading electric vehicle innovators, offers a candid assessment. The biggest adversaries against electrification are big original equipment manufacturers. In other words, the stalwarts of the automotive world, The very companies who have the resources, talent, and scale to drive the transition are often the ones most determined to resist it. Why would automakers, with their immense R&D budgets and global reach, want to slow down progress? The answer lies in their DNA. For over a century, legacy car makers have perfected the art of building, marketing, and selling gasoline-powered vehicles. Their supply chains stretch across continents. Their factories employ hundreds of thousands. Their dealer networks are the backbone of small-town economies. Electrification doesn't just threaten product lines. It threatens entire business models. When the cameras are rolling, executives speak passionately about electric futures. But behind closed doors, their lobbying arms often spring into action, working to weaken stricter emission standards or roll back state-level clean car mandates. Earlier this year, for example, a major U.S. automaker fought tooth and nail to prevent California from enforcing its own ambitious emission standards, and ultimately succeeded, as Senate Republicans voted to strip the state of its regulatory authority. These policy battles aren't just about environmental ideology. They're about defending profit centers, market share, and the status quo. Consider the economics. Gasoline-powered vehicles remain far more profitable for most legacy automakers. Service departments generate steady revenue from oil changes, exhaust repairs, and mechanical maintenance, all of which are drastically reduced in electric vehicles. Electric cars, with their simpler designs and fewer moving parts, threaten to disrupt these lucrative aftermarkets. It's no wonder that, as Scaringe puts it, we're basically on an island fighting all the other original equipment manufacturers. They would never say this publicly, because publicly they're pro-EVs. But the biggest adversaries against electrification are big OEMs, so we fight that hard. This internal resistance isn't just about dollars and cents. It touches on culture and identity. For generations, engineers and designers have built their reputations and their companies' brands on the roar of a V8 engine, the thrill of a manual transmission, or the artistry of chrome and combustion. The shift to electric vehicles isn't just a product change. It's a cultural sea change. It forces companies to reimagine supply chains, retrain workers, and rethink everything from marketing to maintenance. But change is coming, whether the old guard likes it or not. As federal tax credits for electric vehicles begin to vanish, the battle lines are being redrawn, and the United States government, under shifting political winds, has rolled back incentives that once made EVs more affordable. The so-called One Big Beautiful Bill Act eliminated both new and used electric vehicle tax credits, removing a key pillar of support. At first glance, this might seem like a devastating blow to the transition. But in the eyes of some industry leaders, it could be a blessing in disguise. R.J. Scaringe, for one, is surprisingly unfazed. In a recent interview, he explained, "Policy changes. In the end, don't change anything. EVs will prevail." He goes further. The move away from some of the tailwinds that were previously in place for electric vehicles is actually good for Rivian, it's good for Tesla, but it's bad for the US auto industry and it's bad for my kids. Why? Because, with the crutch of government support gone, legacy automakers can no longer hide behind incentives and slow-walk innovation. They are now forced to compete on a level playing field with new entrants. Companies like Tesla, Rivian, and a growing constellation of Chinese and European startups who have built their businesses around electrification from day one. This new era could play out in several ways. The first scenario is a burst of innovation. With subsidies removed, automakers must win over consumers through better technology, design, and value, not just tax breaks. For EV-first players, this is a golden opportunity. Freed from the distortions of policy, true competition can flourish. As Scaringe argues, the removal of incentives forces the industry to focus on what really matters, building vehicles people actually want and can afford. The second scenario is less optimistic. Without the safety net of tax credits, price-sensitive consumers may retreat, and legacy automakers could double down on gas-powered models, dragging their feet on electric investments. This could delay the transition, allowing old business models to persist a little longer. Yet the numbers suggest this is a risky gamble. Global EV sales are already surging, over 4 million in the first quarter of 2025 alone, marking a 35% increase year over year. The momentum is undeniable, and those who resist may soon find themselves left behind. A third, wildcard scenario hinges on policy. Even as federal incentives vanish, state and local governments are picking up the slack. California, for instance, is doubling down on its own ambitious emissions targets, aiming for near-total electrification within the next decade. Other states, from New York to Washington, are following suit. If legacy automakers continue to resist, they risk losing relevance and market share in these forward-thinking regions. Global consulting giant McKinsey predicts that by the middle of the next decade, most major markets will reach near-total electric vehicle penetration. Picture a world where gasoline cars are the exception, not the rule, where electric mobility is the new normal. It's not just the auto industry that stands to be transformed. The ripple effects of widespread electrification could reshape entire sectors. Consider energy. As more cars plug in, demand for renewable power and smart grids will skyrocket. Real estate developers are racing to install charging stations in new homes, parking structures, and shopping centers. Utilities are rethinking their business models to accommodate millions of new electric vehicles. Battery technology, once a niche concern, is now a global arms race, with breakthroughs in solid-state chemistry promising faster charging and longer range. Even global finance is watching closely. Arthur Hayes, a prominent financial analyst, recently suggested that the electric vehicle boom could send shockwaves through the broader economy, even boosting assets like Bitcoin as investors seek exposure to the next technological revolution. The transition to electric isn't just about what powers your car, it's about what powers the economy of tomorrow. So what does all this mean for you, as a consumer, investor, or simply a curious observer of the future? First, the era of easy electric vehicle discounts may be ending. Without generous tax credits, you may find fewer upfront deals on new EVs. But don't despair. The fierce competition unleashed by this new reality could actually benefit you in the long run. Automakers, desperate to win your business, may accelerate their efforts to produce more affordable, reliable, and innovative vehicles. Your next car might not come with a rebate, but it could offer better value, smarter technology, and lower ownership costs over its lifetime. Second, if you're thinking about going electric but are hesitant because of price, keep a close eye on how automakers respond. Industry studies show that about 60% of North American buyers won't pay more than $45,000 for an electric car. If major brands start lowering prices, adding features, or offering creative financing, it's a signal that real market dynamics, not just government policy, are driving change. Consumer power, after all, is a force that even the biggest corporations ignore at their peril. For investors and technology enthusiasts, the message is clear. Watch not what companies say, but what they do. The winners of the next decade will be those who embrace the electric future with urgency and authenticity, not those who cling to the past while paying lip service to progress. When Tesla, Rivian, and other EV-first companies thrive while their legacy rivals stumble, that's your cue about where the next wave of growth and opportunity will emerge. Let's not forget the bigger picture. The fate of electrification isn't just about cars or companies. It's about air quality, public health, and the fight against climate change. The transportation sector remains one of the largest sources of greenhouse gas emissions worldwide. Accelerating the shift to electric vehicles is a crucial lever in the battle for a sustainable future. Every year of delay means more emissions, more health impacts, and more lost opportunities for innovation. Historical parallels abound. Think back to the dawn of the personal computer revolution. In the 1970s, giants like IBM dismissed the PC as a toy. Upstarts like Apple, Microsoft, and Dell seized the moment and rewrote the rules of technology. Or consider the smartphone era. Nokia and BlackBerry clung to old formulas. Apple and Android swept the board. The lesson is clear. Those who adapt thrive. Those who resist are left behind. Of course, challenges remain. Battery prices, while falling steadily, still make up a significant portion of an electric vehicle's cost. Raw materials like lithium, cobalt, and nickel are subject to geopolitical risks and supply chain shocks. Charging infrastructure, especially in rural areas, must expand rapidly to meet growing demand, and automakers must invest billions to retrain workers, redesign factories, and retool supply chains for the electric age. But the momentum is unmistakable. According to the International Energy Agency, electric vehicles could make up nearly 1/5 of the global auto market by the end of this year alone. By the mid-2030s, the world could look radically different. Imagine city streets free of engine noise, skies clearer than they've been in decades, and families enjoying cleaner air and lower transportation costs. So does the end of federal support spell doom for the electric vehicle revolution? Far from it. In fact, it may be the jolt the industry needs to finally get serious. The old playbook of talking up green credentials while quietly lobbying against real change is running out of road. With or without Washington's help, the world is moving electric, driven by technology, market demand, and the courage of companies willing to change. As you consider your next car or your next investment, ask yourself, are you betting on the past or the future? The tipping point for electric vehicles isn't 10 years away, or even 5. It's arriving faster than anyone dared to predict. Those who embrace the change will help define the next era of mobility, and maybe even build a better world along the way. If you want to stay ahead of these seismic shifts in technology and economics, hit that subscribe button and join our community. The electric future is coming faster, louder, and more inevitable than ever. So, what do you think? Will legacy automakers finally adapt, or will bold newcomers like Tesla and Rivian seize the day?